Good afternoon, guys. Today we're going to be going over the CleanSpark third quarter 2025 financial results. I'm going to be going through the earnings and then we're going to watch the call together, which will start here in just about 14 minutes. So if you're here for that, just skip to it. If not, then we're going to go right over the numbers, give my take on it. And let me just get one thing going here on my end so I can have it up. And I hope you guys are having a good day so far. This is a pretty solid earnings as we've seen. All their earnings have been good recently, and it's very exciting to watch this company continue to grow over the last couple months. So let's get right into it. I think the key things for the earnings release we're seeing is that the revenue for the quarter was 198 million, which is an increase of almost 90% from last year, which is 104 million we saw last year. So this is a huge increase as we see in the revenue. Net income was 257 million, which came out to 90 cents per share compared to the loss we saw in the prior quarter last year. Also, the adjusted EBITDA was very strong, which is up almost 400 million since last year. And this comes to some of the highlights as we see here. They've pointed out for us. The cash is 34.6 million, which is absolutely insane. Bitcoin reserve at 1.08 billion. Total assets at 3.1 billion. And this is including the downturn we've seen in the Bitcoin markets, which is what I think is one of the most exciting parts of this. Is we've seen Bitcoin kind of has dipped over the last couple weeks, and the company is still performing very strongly, and it's still showing a lot of resilience inside of the market, which is something I think is something to be excited about and something that I'm watching closely. Watching this, and I'm very excited for this quarter. I got another couple points I was reading up on here. The earnings report literally just came out 10 minutes ago, and I instantly fired up the stream. I think that this is a very strong quarter because we see the massive revenue and profitability improvement for the company compared to last year, and it's signaling a significant turnaround as there's growth in scale, such as the hash rate and the power contracts as we see. And Bitcoin holdings suggest that the company has been able to leverage both its mining operations and treasury strategy to make it into a very profitable company. And the profitable adjusted EBITDA is very encouraging as a company which is in the Bitcoin miner market, as it's very hard to turn a profit in these industries, and they've already been able to do it, which is very promising for the future. In the earnings report, they emphasize that it's been growing its treasury, and it's over 1 billion in value, and reports that scaling did not require raising equity since last year is something that I think is very exciting to watch. Obviously, this is my personal take is that it appears to be executing very well right now in the Bitcoin mining cycle, because they're scaling on these things that are very crucial. We see the growing hash rate, growing revenue. We see it moving to profitability. And right now it is accumulating Bitcoin treasury, which is going to allow it to scale with a profitable narrative in the future. The key question is obviously sustainability. If they can keep scaling, maintaining low energy costs, and mitigating the Bitcoin price. But I think the risk to reward is very optimal for investors, and I think it's a great, like, personally, I'm not, obviously this is not financial advice, but I'm personally looking to be investing here, especially as we see Bitcoin become adopted more and more across the world, and it becoming a currency that everyone is starting to use. I think it is obviously going to have some risks with it, which I have written here on my side here. I think some of the main things that I see as risks are the dependence on the Bitcoin price, and mining difficulties obviously are something that you have to watch. It is very capital intensive, and there's some debt with it has the long-term debt of 600 million, but it has this cash position and this total assets position, which is very strong, and it is very all this mining, their assets and everything are prepaid, and it means their values are all tied up in hardware, deployment, and power contracts, which is what they have been focusing on, which has allowed them to scale so quickly over the last couple weeks, and which is why I wouldn't be worried about the stock price for now and the earnings, because for now they're just trying to expand as quickly as possible. And as we've seen, the adjusted EBITDA, one thing I want to point out, where was it? The adjusted EBITDA, I think it's right here, increased to 377 million. This excludes many items such as the unrealized gains or the share-based compensation, and I think they're still comparable though. I mean, a jump of 400 million is something they absolutely cannot write off, and the only thing you got to really watch for is the Bitcoin price movement. Of course, with a stock like this, the Bitcoin price movement and network difficulty, it's really a question of how sensitive is the price stock price to this happening, to all this stuff. So I think this was a very strong quarter. Um, I think there's a lot to be pulled out of here. I'm excited to hear the call. I think they have a very good management team, which is one thing that has gotten me excited about the company more and more recently. Their model, not only this, but as we know, for this company, it scales extremely well. So once the infrastructure is in place for the company, and once we are able to see the company incrementally petahash produces outsized profitability during strong Bitcoin cycles. So that means that the jump in net income and EBITDA is not a one-off, and it's a preview of what higher Bitcoin prices could unlock. So the shift we see from this negative EBITDA we saw last year to this year is it shows that nearly 400 million positive shows how powerful their fixed cost leverage is when Bitcoin rises. So as we see Bitcoin continue to rise in the stock, I think the stock will continue to rise in line with it, if not even higher. So holding more than $1 billion inside of Bitcoin here, as we can see, is essentially giving shareholders exposure to both a mining business and a growing Bitcoin asset base. So you're basically investing in Bitcoin as well as a company that is mining for Bitcoin and stuff. So most miners sell large portions of their production to fund operations and to continue their cycle, whereas CleanSpark consistently adds to their treasury, which makes it a very strong stock, and it's positioning themselves in a way where basically I see them as a hybrid miner plus a long-term accumulator. So if Bitcoin makes another move towards a higher cycle, their treasury becomes a massive profit center, and we see more money being in the company. So as we've seen, they're long way. There's a lot of more other things I think, because there's the long runway of contracted power. More than 1 gigawatt of contracted power is not normal for mid-sized miners. So this means that CleanSpark has already secured that energy that competitors will struggle to obtain as mining difficulties increases. Obviously, every year we're going to continue to see it be harder and harder to get into this space because it is a very constrained environment where power becomes the scarce resource, and CleanSpark will be able to expand while smaller miners get priced out or even shut down by these big competitors, as well as merged out or bought out. So this creates a consolidation effect that benefits the larger operators such as CleanSpark in the long run. Not only this, but they consistently are ranking among the lowest cost miners when it comes to efficiency. Their fleet uses modern, high efficiency ASICs, and their sites are in energy advantaged regions like Georgia. So even as difficulty arises, their cost of production stays very competitive, and high difficulty environments crush inefficient mining companies, which rewards those with scale and low cost, which is why I think that CleanSpark has a winning trajectory inside this business model. And they are very much ahead in terms of technology, efficiency, and all these other things, as well as having a pretty strong balance sheet, as I was mentioning with this adjusted EBITDA flip we've seen. Also, another thing I want to point out is that many miners have suffered after the halving because rewards cut in half and costs rose, but CleanSpark has been able to survive because it survived this transition and is now thriving as a business, which signals that their operations are built to withstand after the economics of the post halving. So success after a halving often leads to explosive upside later in the cycle because supply drops and margins expand as Bitcoin price rises. So as the price of Bitcoin continues to rise, we will continue to see expansion here, especially as they've shown that the supply drop has benefited their company directly. And a more bullish point is that CleanSparks publicly emphasized that they grew without raising new equity for over half a year. So miners are obviously notorious in the market for dilution. And the fact that this company has scaled without issuing new shares shows financial discipline, operating profitability, and confidence in the future cash flow. So I think if they continue building without dilution, investors get more exposure to the upside, which I think we'll be able to see in a couple months here. We're waiting for the call. Let me turn on the music so we can start listening to this nice music. Oh, it's the classic music. Okay, thank God. I'll just go over a couple more points I have here on the side. The earnings report literally just came out like 20 minutes ago, so I haven't gathered all my thoughts just yet, but I have a good idea of where I'm at. Um, I think that with the Bitcoin Treasury exceeding $1 billion, as we can see here on the sheet, this is it has its real strategic flexibility. So if needed, they can obviously sell small portions of their Bitcoin to fund any type of expansion, acquire distressed competitors, or build new high capacity facilities. So this treasury gives them a very much strategic edge in down markets, and it fuels them for rapid expansion during up markets. So I think this is something crucial to keep your eye on, and for it to continue to grow quarter over quarter shows strong confidence in the company. And I think their operations in Georgia is something crucial to watch, because if you've ever been to Georgia, I know it's one of the lower cost states, and it gives them stable electricity pricing and regulatory stability. So as we know, states like Georgia welcome data center expansion because it creates local jobs and economic activity, which CleanSpark benefits from this long-term supportive environment, like very much so. And with ETFs expanding and involvement growing, institutional investors are increasingly allocating to Bitcoin miners, and CleanSpark is one of the better capitalized ones and more operationally transparent miners. So this makes them a natural beneficiary once inflows from other institutions look into Bitcoin. So I think that if Bitcoin makes a strong move into early 2026, CleanSpark becomes one of the highest beta ways to play it. So between the treasury appreciation, operational profits, and potential hash rate expansion, this company pretty much outperforms Bitcoin by several multiples. And we're just waiting to see how it is reflected in the stock price and how that is a kind of show to us as investors. Right now, we're just waiting for the call. It should be starting any minute now. I think in about 2 minutes. But as I was saying, they're positioned in a very strong way. And as we continue to see this summer, especially as they already hit the 50 exahash this summer, but they hinted at more fleet upgrades and potential expansions as new machines become available. So if they deploy next generation miners ahead of the competitors in the market, they get another step up in efficiency and production, which is also going to be crucial to watch in these coming months, as efficiency and power output is really the main thing that's driving these stocks. And I think they have a real advantage over most companies inside of this market, and it's already showing inside the stock price. I know it jumped up to $12.50 here a couple minutes ago, and it's kind of steady down at the $12 mark, but I still think it's very early for this stock, long term as well as short term. I've always said, instead of investing in a company like, not even a company, inside of Bitcoin, it feels like a better idea just to invest in companies like CleanSpark, where you're already investing inside of Bitcoin because they have this huge treasury and position in Bitcoin, and they're also creating this mining opportunity, which also allows you to get more exposure into Bitcoin. So you're reaping both you're reaping both wins of the stick. You're getting all ends of the stick in a good way, not in a bad way. It's not going any weird places, but you're just winning out on this completely. So that's why I think it's a very good thing to be watching. I'm excited for the call. I don't think there's a presentation. I'm pretty sure there's not a presentation. Let me just check in case. Presentation, webcast. Maybe they'll just be showing it on the call. I hope they do, because I'll be in the call. If I need to move anything, I will on the screen so you guys see everything. But for now, I'll just keep it with the price up and my face on the bottom right with reactions. And I'll be taking notes on the side of my screen so I can give you guys my thoughts at the end of this. And yeah, the call should be starting any second now. It just turned 4:30, so it should be starting here any moment now. So I'll just wait. If anyone has any questions, make sure you drop them in the comments. But yeah, I'm very excited to hear this call. Finally, they got the good music though. I hate when I join like an earnings call and they got like the medieval music. So this is a nice change of pace. I'll say that. Does anyone have any plans for the holidays? I see we got like 15 people in here. Thank you guys for chilling with me, watching this call. I'm very excited. And don't worry about my mic. I'll mute up once it. Oh, there we go.
Ladies and gentlemen, thank you for standing by. My name is Colby, and I'll be your conference operator today. At this time, I'd like to welcome you to the CleanSpark's fiscal full year 2025 earnings results. All lines have been placed on mute to prevent any background noise, and after the speaker's remarks, there will be a question and answer session. If you'd like to ask a question at that time, please press star then the number 1 on your telephone keypad to raise your hand and enter the queue. If you'd like to withdraw your question at any time, simply press star 1 again. Thank you. Harry, you may begin your conference.
Thanks, Colby, and thank you for joining us today to review the fourth quarter and full fiscal year 2025 financial results for CleanSpark. We encourage you to review our earnings results press release, which was issued today and is available on our website. Our 10-K will be filed shortly. A webcast replay and transcript of today's call will be added to our website once available. On the call today, I am joined by Matt Schultz, our Chairman and Chief Executive Officer, and Gary Vecchiarelli, our President and Chief Financial Officer. Some of the statements we make today will be forward-looking based on our best view of the world and our business as we see them today. The statements and information provided remain subject to the risk factors disclosed in our 10-K. We will also discuss certain non-GAAP financial measures concerning our performance during today's call. You can find the reconciliation of non-GAAP financial measures in our press release, which is available on our website. And with that, it's my pleasure to introduce Matt Schultz.
Thanks, Harry. Good afternoon, everyone, and thank you for joining us. I'm so excited to have stepped back into the role of CEO at CleanSpark this past August after serving as executive chairman for the past 5 years. In my first 100 days, the team has been relentlessly cementing our current leadership position in Bitcoin mining while simultaneously positioning us to evolve our portfolio. We've also set a strategic direction for CleanSpark going forward as a digital infrastructure platform serving a wide range of compute opportunities. These opportunities include, but are not limited to, generative AI workloads, grid balancing through Bitcoin mining, and high-performance computing broadly. I've also had the opportunity to meet with many of you listening to today's call. Your enthusiasm for the future of CleanSpark's business means the world to us, and we're excited to execute our strategic plan and extend our track record of operational excellence into AI factories. As the company has matured, I'm inspired by our world-class team and operating business, our strong balance sheet, and most excitingly, our growing power and land portfolio across the U.S. and the optionality it represents. Together, all of these elements are evolving into a diversified compute platform to serve the needs of the next digital age. I've taken stock of what we built, and I want to share with you just how well prepared the company is for this moment in time. While Bitcoin mining remains foundational to our business, we recognize that our expertise in securing power, developing infrastructure, and deploying at scale uniquely positions us to support the fast-growing demand for AI compute. A blended approach to growing and monetizing our portfolio serves to diversify revenue, enhance margin, and build long-term shareholder value. 2025 was the year CleanSpark achieved escape velocity, reaching 50 exahash per second in operational hash rate with 100% US-based infrastructure and run by our operations and technology teams. We delivered record revenues and demonstrated capital stewardship by not issuing a single share through an equity offering throughout this calendar year, all without slowing down our growth. I'm proud to share a few financial highlights from our 2025 fiscal year. We achieved record revenues of $766 million. Our gross margin was 55%. Now, that's a 1% decrease year over year. This small decrease is actually impressive due to this being the first full year post-halving when the Bitcoin block rewards were reduced by 50%. Our Bitcoin treasury grew by nearly 62% to over 13,000, generated entirely from our wholly owned and operated hash rate. This puts us in a fundamentally different position relative to treasury companies purchasing spot Bitcoin, since we mine it at greater than a 55% gross margin and we're actively monetizing our holdings. We now have a sustainable, self-funded mining business thanks to our industry-leading mining team, and they're backed by an innovative digital asset management operation that's generating meaningful premiums and leveraging our treasury balance as a truly productive asset. We're in the process of deploying the 19,000 S21 XP immersion units that have an industry-leading 13.5 joules per terahash. It's beginning this quarter, and we expect that process to be complete in calendar Q1 of 26. Now, while this timeline is a bit longer than we had initially contemplated, our priority was a comprehensive portfolio review to ensure that we would not consume any AI-applicable megawatts with this deployment. We have always had an infrastructure-first thesis. We avoided the asset-light strategies of past cycles, and we prioritized control of power and infrastructure, given the fundamental scarcity we're now seeing borne out in the market. Scaling our mining business required securing and developing a world-class power and land portfolio and growing significant supply chain, engineering, construction, and operational capabilities, all highly relevant as we evolve into AI data center development. Today, we have more than a gigawatt of power under contract live in our data centers and infrastructure. Additionally, we have nearly 300 megawatts in Texas, fully contracted and scheduled to begin energization in early 2027, coupled with a multi-gigawatt pipeline of additional near-term opportunities. Importantly, many of these locations are excellent candidates for AI campuses, while others are best positioned for Bitcoin mining, load balancing, and securing the grid. Our objective is clear: to deliver each megawatt to its optimal use case. We have always had an internal philosophy of people first as we look to expand our business. That was true in the earliest days of microgrid development. It was true as we grew into a Bitcoin mining company. It was clearly a winning strategy when we hired Taylor Monig to lead us to the forefront of immersion cooling. And most recently, it remains true as we added Jeff Thomas to lead our AI data center initiatives following his successful tenure as president at Humane. We've accomplished three key initial steps in our business evolution thus far with Jeff on board. The first thing is we reviewed our diverse portfolio to identify the most productive use of every single megawatt. Second, we secured a 285 megawatt site in Texas with the explicit intent of building an AI factory for a high-quality tenant. And three, we're aligning and expanding our internal team in conjunction with market-leading partners to deliver projects on time and on budget that meet the exacting needs of offtake customers. When we took a close look at our facilities, it became clear that our 250 megawatt site in Sandersville, Georgia, provides an immediate opportunity to host a large-scale tenant. Other sites surrounding the Atlanta Hartsfield Airport, totaling over 100 megawatts with ready access to fiber, are already in extremely high demand. In Texas, the site we recently acquired just outside of Houston will be the location of our first exclusively purpose-built AI factory. We hold 271 contiguous acres of land located on a regional fiber backbone and have executed 285 megawatts in long-term power supply agreements that have already been fully approved by ERCOT. Better still, the site is located near several high-capacity natural gas pipelines, which are being evaluated for industrial scale behind-the-meter generation opportunities. This purchase positions us to deliver scalable, resilient, and energy-efficient capacity to meet demand from AI, cloud, and enterprise workload, and represents a key step in our long-term strategy to leverage our vertically integrated infrastructure-first model. While this may be our first purpose-built facility, it certainly won't be our last. The entire team is focused on first securing tenants for Sandersville and Houston, which will then drive efforts to take the projects from commercialization to commissioning. Long-term tenants represent a superior risk-adjusted return profile, for these assets rather than direct GPU exposure initially. Similar to past industrial revolutions, AI represents a new ecosystem. Power companies, chip companies, hyperscalers, infrastructure technology providers, and others are all collaborating, and we're in direct discussions at every level to deliver maximum value for our customers and our shareholders. Jeff has been building the full lifecycle playbook for AI campus development and operations that best serve this ecosystem. Together, his growing team is already vetting potential tenants, building high-quality site commercialization plans for our pipeline, and defining our project delivery roadmap. As part of those efforts, we entered into a memorandum of understanding with Submer, a global pioneer in liquid-cooled and prefabricated data center solutions. Its end-to-end capabilities, spanning from liquid cooling systems and mechanical, electrical, and plumbing modules to full facility builds, set new benchmarks in energy efficiency, density, and sustainability, making them an ideal partner for CleanSpark's growth strategy. This relationship is our first step in taking elements of the construction process away from the data center and putting them into the factory with approved reference architecture designs to support a broad range of tenant requirements. Together, we're working on an infrastructure platform that integrates power generation, data center development, and AI service delivery. Under this framework, CleanSpark focuses on selecting, developing, building, and operating AI-focused campuses, while Submer will offer its technology and expertise as a strategic vendor in delivering sustainable modular data center systems. Meanwhile, we completed our largest financing ever with a $1.15 billion upsized 0% convertible note. Gary, our President and CFO, will discuss the finer details and numbers momentarily. But before I pass it over to him, there are some elements I'd like to highlight. The terms are even better than our prior raise in December 2024, with the same 0% interest rate, a higher 27.5% conversion premium, and a 6.25-year term. This financing provides the resources to expand our power and land portfolio, seed our first AI deployments, and continue investing in strategic growth opportunities. And as part of this transaction, we bought back $460 million worth of our own stock, more than a 10% reduction in outstanding shares. We've once again bet on ourselves, and we will succeed the CleanSpark way. With that, I'll hand it over to Gary to take you through the financial results, both for the quarter and the full year. Over to you, Gary.
Thank you, Matt. I'd like to start by reviewing the numbers for the entire 12-month fiscal period, which was a landmark year for CleanSpark. Our revenue grew more than 100% year over year to $766.3 million, with almost 8,000 Bitcoin produced. The major driver of this increase was due to a combination for growth in exahash and Bitcoin price. Our full-year gross margin was 55%, which we're particularly proud of, given that this was the first full year post-halving. These margins remained relatively in line with the prior year, which is attributed to the significant increases in efficiency our fleet had over the last 12 months. Also contributing to our gross margin consistency is our average marginal cost per Bitcoin, which was slightly below $43,000 for the fiscal year, while our average revenue per Bitcoin was approximately $98,000. Our margins and cost per Bitcoin represents the strength of our infrastructure quality, our world-class teams, and commitment to managing our business to profitability and margin rather than any single operating metric. Our high margins translated to an adjusted EBITDA of over $800 million, which I must point out does not adjust for certain non-cash items such as the mark-to-market on fair value of Bitcoin. When normalized by excluding our gain on the fair value of Bitcoin, the adjusted EBITDA from operations would be approximately $305 million, which represents a net margin of approximately 40%. Additionally, the combination of increases in margins and fair value of the 13,000 plus Bitcoin we have on the balance sheet contributed to a significant positive net income of about $365 million. Looking at the most recent quarter-over-quarter performance, we also saw significant gains between the third and fourth quarters. Our revenue increased by approximately $25 million, or 13% in Q4 versus Q3, and our margins increased 2 points to 56.5%. It is important to note that we achieved 50 exahash in June, and while that remained our operational high for the fourth quarter, we still experienced increases in revenues and margins because of favorable mining economics during the quarter. Our high uptime also allowed us to capture periods of significant appreciation in Bitcoin price. In the fourth quarter, we recognized a slight net loss compared to the third quarter. This was due to a much larger gain on fair value of Bitcoin during the third quarter and non-cash tax adjustments recorded at our fiscal year end. Our adjusted EBITDA margins also saw similar changes, which is inclusive of the non-cash mark-to-market adjustment on fair value of Bitcoin. However, when adjusting any non-cash mark-to-market effect, our normalized adjusted EBITDA was $97 million for the fourth quarter, a 25% increase over the $78 million normalized in the third quarter. This translates to margins of 43% and 39% respectively. Going forward, we do expect that our professional fees, payroll, and G&A line items will increase as we execute on our AI strategy. Additionally, I will point out that the AI data center business comes with stable cash flows and high margins, both of which will help CleanSpark through the peaks and valleys of Bitcoin mining economics. Our escape velocity translates to operating leverage. We have developed scaled data center infrastructure that is delivering revenue and margin necessary to self-sustain and further support incremental investment in AI data center capabilities as we evolve into a power, land, and compute platform. Turning our attention to the balance sheet, I want to point out that we are one of the first, if not the only company, which has a scaled cash flowing business that is also using Bitcoin as a productive capital asset. The utilization of our Bitcoin stack resides in a team we refer to as Digital Asset Management, or DAM. The fourth quarter was the first full quarter of DAM activity, and we are extremely excited to share in more detail the steps we have taken in our crawl phase. Two initial strategies rolled out by DAM are our Spot Plus and Yield strategies. Both utilize covered calls, but Spot Plus is designed to optimize for the cash needs of the business, while Yield is designed to generate go-forward risk-adjusted output from our treasury holdings. Given that we are monetizing a significant portion of our monthly Bitcoin production, the Spot Plus strategy delivers a tactical uplift to cash generated on a weekly, monthly, and quarterly basis. This program functions smoothly because of the consistent output from our world-class operations and strong uptime. We are able to utilize this approach because of the investment we have made in making DAM a true institutional-grade platform. It began with a comprehensive RFP for a range of products that you have heard us discuss on prior calls, and executing these option overlays requires a disciplined approach to risk management. Rather than selling Bitcoin through the spot market, we utilize at or near the money covered calls to generate both option premium and realized proceeds, if and when we ultimately get called away on these contracts. Our Yield strategy utilizes covered calls as well, but instead of high delta, short duration, we shift delta and extend or ladder term to reduce the likelihood of exercise. Under our Yield program, we saw an annualized yield of approximately 12% on a blended basis. In addition, as we scale our strategy and increase the volume, we believe there's room to incrementally increase the annualized yield and cash generated, potentially significantly. While the fourth quarter represents a period when we were still in the crawl phase of the strategy, we were nonetheless able to generate a total of $9.3 million in premiums. To illustrate what that represents, our average spot Bitcoin sales price for the quarter was $111,721. However, when considering the additional premiums generated per Bitcoin of $4,184, the all-in effective cash generated per Bitcoin was almost $116,000, a material uplift. One of the early wins for the DAM team was the successful monetization of costless Bitcoin repurchase options received as part of a Bitmain miner procurement contract from the third quarter. This was an excellent example of how our investment in the digital asset management function can help us to complete the arc of opportunities driven by our world-class mining operations. While our mining operations drove leverage and preferential terms to obtain mining rigs, DAM was able to monetize that option, which would have otherwise have expired worthless, driving $7 million of additional cash to the balance sheet. Due to the performance of DAM to date, we have increased the volume of transactions subsequent to our fiscal year end. In October alone, we traded more contracts than the total number of contracts traded during the entire fourth quarter. Additionally, we generated over $5 million in cash premiums for the month of October alone. The last leg of our current strategy involves writing puts. The put transactions we enter into are cash secured, primarily using the premiums previously generated under the Spot Plus and Yield programs. While this cash corpus is still growing, we saw analyzed returns of 8% on the put strategy. These three strategies do two things. First, they integrate into our operating business with the enhanced sale of production, and second, create a capital flywheel as they relate to our balance sheet. I would also like to add that the results we are seeing in DAM do not necessarily translate directly to telling the story via US GAAP accounting. While all pieces are reflected across the income statement and balance sheet, there are certain punitive treatments of non-cash mark-to-market valuations at contract expiry. What we think is important about these tables is that, once again, CleanSpark is at the cutting edge of real non-hyperbolic strategies paired with full market-leading transparency. These tables can be found in the Management's Discussion and Analysis section of our Form 10-K. I want to note that US GAAP rules separate the accounting for covered call exercises into two different line items for what is, in substance, a single transaction. These two line items on the income statement are loss on derivative contracts and gain on fair value of Bitcoin. This is important because there are two sides of the same transaction. For example, the difference between the spot price at expiry and the strike price is shown as a loss on derivative contracts, while the corresponding markup in Bitcoin value to the spot price is recorded separately as a gain on fair value of Bitcoin, offsetting that non-cash loss with a non-cash gain. Taken together, they reflect the economic outcome of our covered call program, which continues to generate attractive risk-adjusted returns. I also want to point out that the Bitmain option was effectively costless to us. However, GAAP required us to bifurcate a portion of the ASIC contract to the option value, even though the contract didn't explicitly state a value. That value of $6.8 million was recorded at contract inception in the third quarter. As the option ultimately expired out of the money, had we not taken steps to monetize the option, we would have had a non-cash write-off of that $6.8 million. However, instead, we generated almost $7 million of cash on that option, which under GAAP considered it to be a net gain of approximately $200,000, even though we ended up with $7 million more cash in the bank at the end of the day. The overall takeaway is that the digital asset management strategy has met and, in fact, exceeded our expectations thus far and become a second source of cash generation to the business. We are looking to increase the size of our team to allow for greater volume and more complex derivative trades, which we believe will not only grow the total cash generated from premiums, but also maintain attractive yields. On a final note, I'd like to take some time discussing our capital strategy. Our focus is on building a capital stack which minimizes dilution. This starts with the sale of monthly Bitcoin production to cover our monthly OpEx. We also have Bitcoin-backed lines of credit with a total capacity of $400 million. We will continue to use the lines of credit opportunistically in the marketplace for accretive acquisitions. And as we previously mentioned, we issued a $1.15 billion convertible note with a coupon of 0% and a conversion premium of 27.5%. Proceeds from this transaction were used for several purposes. First, we bought back $460 million of our stock, which represents a reduction in our outstanding shares of 10.9%. The stock buyback not only helped facilitate the convert, but we saw this as a bet on ourselves as we see our valuation increasing given the opportunities in front of us. Second, we used over $200 million from that raise to pay off our lines of credit. It's important to note that we have access to the full $400 million line available to draw down at any time on terms we continue to believe are market leading. The remaining net proceeds from the transaction will be used to do what we have a proven track record of doing, and that is hunting for power and land. The acquisitions of power and land, such as the most recently announced transaction in Sealy, Texas, are expected to be permanently used for our AI data center strategy. While we are in the early innings of our AI data center journey, the market is moving quickly, and so is CleanSpark. Our conversations with off-takers are ongoing, and it is not a matter of if, but when we will have our first customer. Details regarding financing of our data centers will be coming in future periods. However, I will tell you this. There is an abundant amount of capital at a much lower cost of capital than previously available to our mining business. Our venture in the AI data centers will open new pools of capital, allowing us to benefit from the significant levered rates of return the market is providing. To close out another strong and defining quarter for CleanSpark and to discuss how these results position us for what's next, let's return to our Chairman and CEO, Matt Schultz.
Thanks, Gary. Wow. As I listen to those results, I can't help but think back to the earliest days of this company and the journey we've all been on together. Our fundamental thesis on being infrastructure focused and people first has served us incredibly well. They are two of the reasons we have such a meaningful opportunity in front of us today to grow into an infrastructure and compute platform that maximizes the value of every megawatt. The task in front of us is clear. We're working to secure tenants at our two initial flagship AI-ready locations while simultaneously expanding our land and power footprint to meet the market's insatiable demand. These efforts are made possible by our strength as a scaled Bitcoin miner, our capital markets rigor, and critically, our company's cultural focus on operational excellence. This past summer, our operations team coined the motto, "Be the standard." I had the pleasure of having them present to me what that phrase meant to all of them. And I commit to you that in each of our endeavors, you can count on CleanSpark to continue to be the standard. I want to take a moment to thank our entire team for their tireless work. I'm beyond grateful to our shareholders for their trust, and I truly appreciate all of you for joining us today. With that, I'll hand it back to Harry to lead us into Q&A.
Thanks, Matt. We will now open up the floor to questions from the analyst community. Operator, please provide instructions and manage the queue for the Q&A session.
Thank you. We will now begin the question and answer session. If you'd like to ask a question, please press star, then the number one on your telephone keypad to raise your hand and enter the queue. If you'd like to withdraw your question at any time, please press star one again. Your first question comes from the line of Brian Dobson with Clear Street. Your line is open.
Hey, good evening, gentlemen. Just a quick question. There's been a considerable amount of volatility in the stocks as of late. Perhaps you could take this opportunity to give us a little bit of color on the types of conversations you're having with potential clients and your outlook for demand in the HPC AI space over the course of the next 2 years.
Yeah, absolutely. Brian, thanks for calling in and thank you for the question. I can tell you that we've had extensive conversations. Now, I posted on my social media, our whole team was invited to Northern California to spend some time with the team at NVIDIA. From that meeting, we've had subsequent follow-ups, and I can tell you that there is, I don't want to say a bidding war, but strong multiple layer inquiries about Sandersville specifically, and we're starting to gain additional traction on the Sealy, Texas site. So we feel like the demand is there. Obviously, there have been some delivery challenges and credit risk on some of the other peers that maybe haven't been able to perform to the expectations, but we're based on the fact that we're running a company with nearly an $800 million annual run rate at 55% gross margins. we have the cash necessary to get us to that next level. So we actually feel very optimistic about it.
Yeah, outstanding. And as you're thinking about various campuses, what do you think about pairing Bitcoin mining with HPC campuses to provide, call it power usage versatility, or do you think that they'll be separate to start?
That's a really thoughtful question. We were invited by Jack Dorsey and his team to go to Dalton, Georgia, and spend some time as they launched their new domestic manufactured ASIC, the proto rig that's built by Block. And it was a fascinating event. But leaving the event, the CEO of the utility there in Georgia grabbed Gary, Harry, and myself and asked us to go to lunch. And he shared that there's about 120 hours a year that really causes problems for the utility. And he said, historically, they love Bitcoin miners because of the interruptible load. Now, we've experienced providing that service in load balancing in many of our jurisdictions. I mean, you've heard the stories about, redirecting power in Georgia to a hospital when the hurricane hit or whatever the case may be. But the takeaway from the utility was they're interested, and the fear that came from them was because Core Scientific is a big consumer of power there in Dalton, and it's historically been a flexible load. And the concern is that extra 120 hours a year when they need somebody to be able to give back. So what they specifically, the request from us was to consider blending AI, HPC, and Bitcoin mining so a component of those loads remain interruptible. So we see it as a dual-pronged strategy, and I think you'll see a lot of our sites will serve both loads.
Excellent. Thank you very much for the thoughtful answer.
Your next question comes from the line of Mike Colonnese with H.C. Wainwright. Your line is open.
Good afternoon, guys, and congrats on a strong fiscal year here. First one for me on the HPC side. I'm curious, what are some of the key development milestones that investors should be on the lookout for in 2026 as it relates to the HPC strategy? It sounds like the near-term focus will be on deployments at your Texas and Sandersville sites, so it'd be great to get some more color there.
Yeah, that you nailed it, Mike. I can tell you, I had a conversation not with a NeoCloud or anybody like that, but actually with the senior director of site development for a global hyperscaler last night on my way leaving here. And what he shared with us is their 2026 forecasts are so constrained that they're looking at alternative types of builds just to facilitate the needs for 26. The takeaway from the conversation was Sandersville and Sealy, because both of them can be energized. Sandersville is live and active right now, powering 11 exahash of Bitcoin miners, but it could switch to a 200 megawatt critical IT load and be online, in a reasonable period of time. And I think kind of a cool thing that maybe has gone unnoticed, and that is this MOU with Submer. We don't historically, if you look at CleanSpark's past, we don't announce MOU or LOI or anything that isn't definitive or concrete. It was really important to ink that with Submer because of the way that they approach the business. Submer has approved reference architecture for AMD, for NVIDIA, and they build the entire MEP solution, so mechanical, electrical, and plumbing, with all the fiber runs. They take that out of the field, put it into the factory. So a company like CleanSpark builds the powered gray shell. We contract with Submer to roll in the MEP solution specifically to the reference architecture of the end user requirements. So speed to market is really, really critical right now. And having that modular approach, I think, is going to be a massive differentiator for us.
Yeah, that's helpful color, Matt. Appreciate that. And then the second one is on the Bitcoin mining side. I know you mentioned some of these near-term deployments you guys are looking to install in the first quarter. Just remind us of what your near-term expansion plans will look like for the Bitcoin mining business and existing site expansions versus any sort of new development opportunities on the greenfield side or mergers and acquisitions at this stage.
Yeah. So I think what you're going to see is a migration of our Bitcoin mining away from areas that are closer to major metropolitan areas that are maybe more sensitive to utility rates and into more remote locations. There are a number of utilities that have either recently passed or are discussing blockchain-specific tariffs. To my point on the last question, that interruptible component of the load is in such demand that they give us favorable rates, whether it's TVA or Wyoming or any of a number of different jurisdictions, to have the offtake that allows us to flex and to assist the utility. So I think what you'll see is locations like Sandersville, locations like the Metro Atlanta sites in Norcross and College Park, et cetera. Those will probably be prioritized for HPC AI because of the quick access to fiber, the low latency loads that they can serve, et cetera. And then the Bitcoin mining from those facilities will likely migrate out to some of the other locations. So to answer your question directly about scale, we're at 50 exahash per second right now. We have 6 exahash of the S21 XP immersion miners. We had slotted out a deployment strategy. Now, we use modular immersion-cooled data centers for the vast majority of those. When we secured the 100 megawatts in Wyoming, we actually beat out a hyperscaler because of the fact that Wyoming wanted to energize those megawatts today and not in 3 years. So we have the infrastructure purchased, delivered, on hand, ready to roll to deploy these in very short order. So I think what you'll see is between now and towards the end of Q1 26, calendar Q1, you'll see that additional 6 exahash come online. Above that, what you'll see is as we do fleet upgrades, not in the $250 million capacity that we've historically done, but in a more disciplined, more thoughtful manner to ensure that we're protecting our share of the hash rate and supporting what we believe to be a national security issue, and that is ensuring that there's Bitcoin mining hash rate domestically. So we're going to take a real balanced approach at that, but you'll see us continue to grow. And really the differentiator is just in the fact that we have right now one of the most efficient fleets in the world. And with the deployment of this 6 exahash of 13.5 joule machines, we'll have hands down the most efficient fleet around.
Great. Thank you for taking my questions, Matt.
Thanks, Mike.
Your next question comes from the line of Paul Golding with Macquarie Capital. Your line is open.
Thanks so much, and congrats on a strong finish to the year. I wanted to ask, with the 13,000 Bitcoin on the balance sheet, around $1.2 billion at fiscal year end, and with the recent financings that you've done, how should we think about the total aspiration to build this powered land bank as you think about the opportunity to bring tenants in for HPC or to simultaneously grow your Bitcoin mining fleet as you were just discussing? And then I have a follow-up. Thank you.
Thanks for the question, Paul. Our tune around the Bitcoin stack really hasn't changed, right? To give you context, we consciously had stacked the Bitcoin quite rapidly over an 18-month period, and that brought us to about 13,000 Bitcoin on the balance sheet. And we believe that we're one of the only companies using it in the strategic way that it should be used as a capital asset. So I think going forward, what you can count on from us is a few things. One, we'll continue to monetize the Bitcoin stack through yield strategies to generate some cash. Two, we'll continue to borrow against it to be opportunistic, to draw down on cash, to make sure that we're nimble in the marketplace and take advantage of accretive acquisitions. And we've always said that we're not ideological about the Bitcoin balance. We're very strategic. And so if there comes a point in time where we needed to, or we felt that the right thing to do was to part with that Bitcoin balance through sales, we most certainly would do that, and we were open to do that. Because again, we've built this entire company and even the financial wherewithal on optionality. But I'll tell you that, with those sales comes punitive tax treatment because we have mined those at such a low basis. we'll have to pay, we'll be a cash paying taxpayer on those items. So we take those into account when we're looking at the stack. But overall, we'll continue to use this as a form of non-dilutive capital.
Got it. Thanks, Gary. And then turning to the MOU with Submer and Matt, the explanation you were just giving on how you might break out the shell development versus the MEP componentry. How should we think about the potential economic impact of that, if you can give any color? Just thinking about how pricing on some co-location deals involves yield on cost, and of course, build-to-suit can involve more capital, but with a partner. Just looking for any additional color you could provide. Thank you.
Yeah, great question, Paul. Thank you for joining. So the Submer relationship really was born out of a prior relationship between Humane and Submer. Jeff had a working relationship with Patrick, the CEO at Submer, and we've also got Submer infrastructure deployed in our Bitcoin mining side. So we're very comfortable with them, and I can tell you that the quality of the product that they deliver, it's much simpler in the Bitcoin mining side than some of the other modular immersion cooled type companies. But because we haven't done a deployment domestically and they're just spinning up a manufacturing facility in Houston, I don't want to comment too much on what the cost per megawatt is, but I can tell you in general terms that the cost to build out a megawatt of mining infrastructure is about $1 million. To do the same for AI and HPC, according to the reference architecture required by the major chip manufacturers, it's closer to $10 million. We also know that the mechanical, electrical, and plumbing, the MEP solution, is a pretty extensive, pretty robust build out because you've got all those trades working inside a facility at the same time. Building these in a factory increases the speed to market by an order of magnitude, and the initial representations are that it saves us anywhere from 10 to 15% over a stick built in the field deployment. So we believe there's cost savings and speed to market that give us a very unique competitive advantage.
Fantastic. Thanks so much, and congrats again.
Thanks, Paul.
Your next question comes from the line of Greg Lewis with BTIG. Your line is open.
Yeah, hi. Thank you, and good afternoon, everybody, and thanks for taking my questions. I guess Gary or Matt, I was hoping you could talk a little bit more about the Texas facility and just kind of, you mentioned it starts to energize in 2027. Is that energization? Is there steps along the way? And then, longer term, as we think about that site, is there the ability to expand at that site or potentially grow with the customer?
Hey, Greg, it's Harry. I want to give you the rundown on Texas because I think it's a really exciting project for us. And it's the beginning of what you've seen from us across the Georgia, Tennessee, and Wyoming markets, which we take a fundamental land and expand approach, which is we get a foothold, and then we know that once we have that toehold in the market, the opportunity to significantly extend our footprint is available to us. The energization schedule there is that the first 200 and change megawatts are scheduled to come online first half of 2027, and then there's 240 megawatt tranches in 28 and 29. But what's critical is that the counterparty that we purchased the land and the contracted power from is also among the largest substation developers in the state. And so what we were able to step into are the long lead time items and the placeholders that they had on those components, giving us a high degree of build certainty to land the power on the site. The second piece is that site is fully ERCOT approved. And so when we look at the energization schedule, we've already passed all of the regulatory hurdles that would typically be associated with a project in the state. The final piece of what you asked that I want to touch on is about expansion. And, the ERCOT approval status wouldn't come with the expansion on grid that we're looking to accomplish there. But one of the parts that was most attractive, not only to the power contract at that particular location and the service point from the utility that's going to be delivering to us, but it's also the parcel that's there. we have significant land capabilities to be able to digest more power in the same type of AI data center footprint that's going to be represented by the 285. And so we're excited about the scalability. Matt touched on in his comments the behind-the-meter gas generation opportunity, but this is where we find ourselves at our true core competency, which is being an opportunistic acquirer of land and power, not only because we're able to locate high-quality assets for our portfolio today, but also for what those assets can represent to our business going into the future.
Okay, 100%. That was super helpful, guys. Hey, have a great Thanksgiving and talk to you soon.
You too, Greg.
Happy Thanksgiving, Greg.
Your next question comes from the line of John Todaro with Needham & Company. Your line is open.
Great. Thanks for taking my question. Congrats, guys, on the progress here. First question here, as it relates to the AI readiness at Sandersville, just remind us if that site has forced curtailment, and then if so, really kind of how much should we earmark for HPC versus mining if you intend to kind of have both at that site?
Yeah, thanks, John. So, what's important to understand about the Georgia and the MEAG power specifically is that it is not subject to forced curtailment at that location. It's part of why we didn't just trip ball and land with an AI thesis around the Sandersville assets. Those were also inbound because of the highly attractive nature of the Georgia power markets more broadly. And so we feel great about the applicability of that location to the ultimate AI campus use case, and how we balance that versus the Bitcoin mining is going to be the way we do everything, which is a fundamental return on investment profile. We take a measured approach, we're data driven, and the early indication is that every one of those megawatts is highly applicable for AI as its highest and best use, but we're going to remain data driven across the analysis period for that asset.
Great. Thank you. That's helpful. And then just as it relates to credit becoming a little bit of a concern out there, especially as it relates to NeoCloud customers, just walk us through how you are thinking about the customer profile, if there's a maybe bigger focus on hyperscalers now than maybe a couple months ago when you guys were initially thinking about it. And then also, hyperscaler backstops, is that starting to become a necessity? Would love to get some color on that.
Hey, John, thanks for the question. I'll tell you this about the financing. And I mentioned it in my prepared remarks, is that there's new pools of capital that are going to be available to us at much lower cost of capital. So we feel really good about that. We know we're going to introduce at some point secured debt into the capital stack. So we're closely monitoring the deals that are going on and the debt markets. But I'll tell you, the focus really first is to get that high credit quality tenant in there to make sure that we can get the best deal possible, because as you know, levered IRR is significantly higher. The higher the loan to value is. But I'll also tell you that while we might expect to get debt at about an 80-85% LTV over time, we have no problem also bringing a little bit more equity to the table, maybe at a 60-70% LTV for the first project or two. Yes, that will decrease our levered IRR just a bit, but it'll also produce cash flows in the interim, which would also be helpful. But ultimately, to us, it's really going to come down to execution, for which we still think that the industry hasn't proven. But we're going to see that over the next 12 to 18 months, particularly as we bring our land and power to market. So, I don't have specific answers for you right now, but I'll tell you that we are confident that there's a number of options for us to get financing at attractive prices and get the levered IRR that this market's offering.
Terrific. That's helpful. Thanks, guys, and congrats again.
Thank you.
Your next question comes from the line of Reggie Smith with JP Morgan. Your line is open.
Hi, guys. Congrats on the quarter and on the pivot. I guess I had a question on the Sandersville site as well. I'm not sure if you guys talked about what type of CapEx would be required to upgrade that to HPC, or if it's ready, like kind of move-in ready now. And then I'm curious, I know it's early, have you thought about, the use cases, whether it would be used for training or inference, and whether that at all plays any role in the price that you may be able to get to kind of lease that space out? So like, does inference pay more or generate more revenue per megawatt than training? Any insights you can provide, at least around how you're thinking about, kind of self-appraisal of the site and what it could be worth?
Hey, Reggie, thanks for joining and thanks for the call. You've been to that Sandersville site, I believe, on some of our show and tell journeys. And I think what's important to note is the facility as you saw it would not be a conversion to HPC AI. We have a phenomenal relationship with the economic development director in the county. And so we secured an additional plot of land, hundreds of acres of land that's immediately adjacent. So what you would see would be construction that is parallel with Bitcoin mining continuing. And when we're ready to energize, we literally flip the switch, de-energize the Bitcoin mining and migrate that out and go to compute. Now, specific types of compute. Jeff has built a model. Obviously, you have the Giga Campus, which is large-scale training. Those are generally close to a gigawatt and above. Then you have the Mega Campus, which is that kind of sweet spot, 200 to 800 megawatts. And that's generally perceived to be kind of a combo site where it's inference and training, or primarily inference, depending on the offtake client. The last mile, or the low latency, real mission critical sites like what you've seen in and around Metro Atlanta would be kind of the exception to that rule. And those would obviously be low latency inference type operations. So this is going to be, I think Sandersville is going to be an interesting case study, because quite frankly, the demand that we're seeing is for multiple 190 to 200 megawatt critical IT loads, and the off-takers are asking for 2026 delivery. So there's some real challenges in getting that tipped up in time. But as we saw, even with companies like Meta, for example, they're putting tents up and using behind-the-meter gas at 12 cents a kilowatt hour, because the demand is such that there's no sensitivity to those utility rates. So we really feel like we're uniquely positioned in this, Reggie. And you and I, when you first launched coverage on CleanSpark, we talked about the fact that, when CleanSpark entered the space, there were a handful of household names that were the standard from Bitcoin mining. We mined our first Bitcoin in December of 2020, and as of today, we have more hash rate in the United States of America than anybody else. Our uptime is second to none, and I think you can count on seeing that same type of operational excellence and efficiency rolled into our next strategy. And Jeff is just a perfect guy to lead those initiatives.
And if I can get one more in, I'm not trying to nail you down to a timeline, but I'm kind of reading between the lines. Like, I think about Cypher, and they purchased a property in Texas a year ago, and kind of just now announced a deal. And I understand that it takes a while to sort these types of things out, but I'm curious, like, how you're thinking about it. If it took you a year to sign a deal, would that be, in your eyes, satisfactory or kind of disappointing based on what you're seeing from a demand perspective now? Like, should we think of something, much sooner than that? Like, any color you can help on how you're thinking about that in terms, personally, would be great. Thank you.
Yeah, so that's a phenomenal question. And I can tell you that, you called me. I was at my kid's basketball game. You called me when CoreWeave announced their deal, and we talked about what the demand portfolio or the demand profile looked like back then. And at that point, it was, we're going to convert these megawatts and we're going to identify a customer. I think there's been a complete paradigm shift in the space. And now you have customers knocking at the door because they have loads that need to be served very rapidly. So what I can tell you with I would say a strong amount of certainty is you'll see a lease executed much quicker than what you've seen in the space. And the flexibility that's now come, we look at some of our peers that have extended their energization schedules because they're falling behind on construction, et cetera. The hyperscalers and the end users that we're having conversations with, we've made it abundantly clear we're constrained like anyone else for the MEP side, but we have a distinct advantage. So I think what's likely to happen, and Reggie, quite frankly, there are two different off takers that want to sign lease agreements by year end. Is that going to happen? It's hard to say, but the demand is there. It's real, and as I mentioned in earlier comments, we were working on this script and the slide deck that we showed today, and I left here at 8:00 last night, and the global director of site selection for a hyperscaler was calling me wanting to confirm that they were still in the running. So I don't think there's any question that you're going to see a lease much quicker than a year.
That's great. Perfect. Congratulations.
Thanks, Reggie. Happy Thanksgiving.
Your next question comes from Brett Knoblauch with Cantor Fitzgerald. Your line is open.
Hi, guys. Thanks for taking my question. Maybe, Matt, just on the land and power procurement side of the equation, could you comment on what you had to pay for the new site in Texas that you guys just announced? And
Yes,
I don't think you guys are one out there that are looking to go out and find additional land that is energized soon. I think all of your peers, even hyperscalers, are probably looking to do it themselves. So, I guess, how hard is it? How expensive is it? And how much is there out there that you think you can go out and buy that is kind of turnkey ready, similar to the site that you guys announced in Texas?
So yes, I could say what we paid for it, but I'm not going to, and I'll tell you why. There are some very fertile hunting grounds in the ERCOT region, and we don't want to price ourselves out of the market. What I can tell you is that the acquisition cost was a combination of equity and cash. We obviously filed the appropriate filings for the share issuance, but the purchase price of that land and power came in line with what you're seeing in the market towards the low end of that range. Our advantage, I think, in securing land and power and speed to market is really because we've continued to state that Bitcoin mining is going to be a part of what we do going forward. And 18 months ago, when we were invited to sit down at Mar-a-Lago with Donald Trump during his candidacy, he brought in Senator Haggerty from Tennessee. And because the question that came was, can Bitcoin miners actually plow the road, so to speak? Can Bitcoin miners go in and monetize megawatts for a utility that needs to generate revenues now, or for an energy developer that needs to monetize their power while they're waiting for an interconnect agreement? And so Mr. Trump asked Bill Haggerty, can Bitcoin miners do that? And what he said is, unequivocally, they not only can they, but they do in TVA, and CleanSpark is one of them. And so when we talk about Cheyenne, we're driver 9-iron across the street there from F.E. Warren Air Force Base, and there's another $1 trillion company, $1 trillion market cap company that's in our same neighborhood. They were bidding for those megawatts. And, we won. We didn't win because the utility thought that our balance sheet was prettier or we were a better credit risk. We won because we said, if you sell us those megawatts, we'll start buying them in 6 months, not in a year and a half or 2 years. So I think, long answer to your question, I think being a Bitcoin miner with a diverse mining portfolio and the flexibility of the modular deployments that we've done on some of the sites that you've actually seen, it gives us an advantage to jump in, monetize those megawatts on a small portion of the campus while we're tilting up the powered shell in the background. So, I think our speed to market is complemented not only by the modular approach with the Summer partnership, but also by using Bitcoin to go in and buy the power today.
Awesome. Really appreciate it, guys. Happy Thanksgiving.
Thanks, Brett. Have a happy Thanksgiving too.
Your next question comes from Jim Missouri with Chardon Capital. Your line is open.
Thank you. Good afternoon. Is Sandersville the only existing mining site you've identified for critical IT applications, or the first one, and there's going to be others?
Hey, Jim.
Identified?
Yeah. Hey, Jim, thanks for the question. The answer to your question is B. It's the first one. The inbound inquiries we've had for the 100 megawatts surrounding the Atlanta airport are second in urgency only to Sandersville. And Sandersville is because it's 250 megawatts energized operating today. The demand for College Park and Norcross is because it's low latency in the most dense compute environment in North America outside of Northern Virginia. So there's a tremendous amount of demand there, as well as some of our sites in Tennessee. So it's really just a sorting process. And as we mentioned in our prepared remarks, we've done a portfolio analysis to kind of determine we don't want to move Bitcoin mining infrastructure into a facility that's going to be rapidly pivoted to an AI HPC deployment. So I think the answer is Sandersville is the low-hanging fruit that everybody wants. The Metro Atlanta stuff is second, and then we've got a whole bunch of third-place sites.
And the way you described it, it sounds like that flipping of the switch from mining to AI can take place before the Sealy facility is energized. Am I understanding that correctly?
Yeah. So think about it this way, Jim. Our facility in Sandersville is purpose-built Bitcoin mining. We have a couple hundred acres adjacent. We're going to build on that land while we're still mining. Now, the speed to market, really, the summer is a big differentiator. As I mentioned before, there are hyperscalers that are popping up tents because they need access so quickly. So I think it's a relative question. The Sealy the Sealy project is very appealing because we've done all the analysis, all the engineering is done. We've gone to the levels of completing the survey and finding where there are easements for the gas lines on site, et cetera. So we can configure the footprint based on the needs of an end use customer. So we spent a great deal of time in NVIDIA with some of their teams, and they have a giga site. They have all the reference architecture for a GB300 deployment for a gigawatt of power, and everything is detailed down to the inch of fiber runs. So that type of build is obviously much more detailed and going to take a longer period of time than tilting up a powered shell and slotting in a modular solution like you'd see from a Submer, like you'd see from a company like Integra out of Houston. There are a number of these companies that provide that full MEP turnkey solution. So I think what is likely to happen is we'll probably execute on both simultaneously. The delay on Sealy, and it's not really a delay, it's just the energization schedule on ERCOT is fixed. The cool thing about that is the large load studies are done. There's no if, it's just when. And the first 207 megawatts energizes the first half of 27. Their commitment is April, but they have flexibility for the first half. So I think, the conversations we've had with off-takers for Sandersville, they're looking to get something in the books fast. With Sealy, it's also high demand, and with the understanding that by Q2 27, it's energized, and you can build in the meantime.
Understood. Thank you. And just one more, if I might. You talked about increased expenses, and given that, as well as the recent prices of Bitcoin, will you need to sell the entirety of your Bitcoin production in order to cover your expenses?
Not at all. We're generating 600-700 Bitcoin a month, and we're doing so at a 54-55% gross margin. So the expenses we talked about, and as we're building, I think it really depends on the lease we put together and the ability to leverage that lease for financing. But what we're seeing is that depending on the credit quality of the end use tenant, the LTVs are anywhere from 15 to 30%. Having just put up, or the inverse of that, 70 to 85%. Having just put up that $1.15 billion 0% bond, we're sitting on a pretty healthy stack of cash. And then, as Gary mentioned in his prepared comments, we have $400 million in low single-digit interest unused capacity on Bitcoin-backed credit facilities. So I think you'll see us take more of a hybrid approach rather than sell the stack. And then the last thing with regard to the compressed margins in the environment, having the highest uptime and the most efficient fleet in the nation means that as energy prices press up, margin compression happens to everybody. We just happen to make more money out of the same megawatts because of fleet efficiency and uptime. So, I tell the story. It's like when, my grandfather told me when two guys are camping in a tent and a bear walks into the campsite, and the one guy puts on his shoes, and the guy says, why are you putting on your shoes? You can't outrun a bear. And he said, I don't have to outrun the bear. I just have to outrun you. And that's really what we see as our Bitcoin mining advantage. There are still industrial scale miners operating fleets greater than 20 joules per terahash with not significantly better power pricing than we do. So we have a ton of flexibility, and I really like the position that we're in to continue using Bitcoin mining.
Your next question comes from the line of John Hickman with Ladenburg. Your line is open.
Hey, as you might imagine, most of my questions have been answered. But I was just wondering if you could maybe opine about, there are others in the space that are trying to do the same thing that you're doing, taking Bitcoin sites and moving them over to HPC and AI. And they've been, telling us they're going to do this, and it's been a year's gone by, and there's no lease. Could you opine as to why it would be taking so long when there's so much demand?
I'll tell you from my perspective, and then I'd certainly invite either of my colleagues to chime in on it. What we learned when we spent some time with NVIDIA and AMD, there are very specific reference architecture that is required for specific clusters. And I think that the challenge that we're seeing, and I'm certainly not casting aspersions on anyone's strategy, but I think if there's so much demand for a hyperscaler, but they want a specific cluster, be that the new Google chips or AMD or NVIDIA, the site needs to be specifically designed for those clusters. And I think building a site and then suggesting that it's flexible for somebody else to reconfigure or modify it, it could be useful, I think is a little bit of a challenge. So to have it purpose-built to the specific architecture of the off-taker, I believe is a real advantage. And having all these sites that are already energized, that we're currently using those megawatts to mine Bitcoin, give us that flexibility. I'm not in a rush. I don't have to do anything, quite frankly, until we have a lease. I don't even have to start construction because I want to make sure that it's built to suit for the offtake customer. So I guess my perspective, John, and again, I invite Harry or Gary to comment. I think that build it and they will come mentality doesn't apply if it's not to the specific architecture requirements of the end user.
I would just add one quick thing, John, which is just that the market today is different than the market a year ago. The demand profile is accelerated. The crunch for power is tighter than it was. And so we're seeing some of the hesitation that some of these off-takers might have had 12 or 18 months ago. The sense of urgency is just more significant. And that's going to represent a difference in execution timelines today than they would have looked like back then.
Okay. And then I just have one question. On Sandersville, when you get the AI part built and it's time to flip the switch, what happens to the Bitcoin mining site?
So fantastic question.
Would they have no power? You shut it.
So
just shutter it, would you?
Yeah, no, a couple of opportunities there. First and foremost, the ASICs would be migrated to a facility that needs them right now, and there's always plenty of demand for that. The facilities that we built, and John, I don't remember if you visited Sandersville on our analyst day, but the facilities at Sanders, okay, so they're identical to what we built in Jackson, Tennessee, as an example. So the cool thing is we build all the foundational stuff, and then what goes vertical is basically bolt together. So we have the ability to repurpose those buildings based on any number of different factors. But no, it wouldn't be a write-off and mothball it. It would be repurposing those assets for deployment elsewhere.
But you'd need more power.
Yeah, for sure. That's why we would move it somewhere else.
Okay.
Like, for example, Wyoming or Tennessee or even other sites in Georgia. We would for sure. Now, Sandersville is a bit of an anomaly because there are some opportunities for power expansion there. And that's something that's still out for discussion.
Okay.
But the demand is significant.
Okay. Well, thanks. Appreciate your time.
Thanks, John. You bet. Happy Thanksgiving.
You too.
And with your last question, it comes from Nick Giles from B. Riley Securities. Your line is open.
Great. Thanks for squeezing me in, guys. You spoke to a multi-gigawatt pipeline, and I was hoping you could break that down a bit. I mean, how many of these opportunities would you describe as late stage, or how soon could we see those drop down? And then which of your existing power markets do you see most of these opportunities? Thanks a lot.
Yeah, Nick, great question. And I want to give you a historical example to kind of illustrate, why we don't always give direct pipeline granularity as our business. So you look back to the prior quarter's call, we talked about pipeline, and it was contemplated in that environment. What wasn't contemplated in either of those numbers was the 285 megawatts that we purchased in Texas. And that's because the relationships that we have across the utility and infrastructure space are diverse, and they're all very warm and deep. And so there are opportunities that come out of the woodwork along the way that leapfrog to the front of lists that we thought were very set. And so it's part of our capital strategy to have dynamic flexibility and execution with speed. And it's also part of the pipeline and relationship management that we do work on across the infrastructure and utility partners that we have. And so that type of dynamic flexibility is why we've been successful acquiring power and land and developing it with the quality that we have. And so when we look at that multi-gigawatt pipeline, a lot of those regions where we see expansion opportunities are places where we have deep relationships, the Georgias, Tennessees, Wyomings, and now Texases of the world. But some of the utilities that serve those regions, I'll use TVA as an example because I'm a homer. Tennessee Valley Authority serves 7 different states. And so while it's the same utility partner, it bleeds outside the lines of the great state of Tennessee. And so those are the types of dynamics that we see replicated across those relationships, and part of why we feel so good about the pipeline growth opportunities and why we capitalize the business to hunt power and land, just like Gary said.
Understood. Well, guys, I appreciate the update and have a great holiday.
You too, Nick. Happy Thanksgiving.
And with no further questions in queue, I'd like to turn the call back over to Harry for any closing remarks.
Everyone, thank you again for joining today's earnings call. We look forward to staying in touch and sharing future results with you in the coming quarters. Stay tuned for more progress and exciting achievements ahead of us at CleanSpark, America's Bitcoin miner.
Okay, guys.
This concludes today's conference call. You may now disconnect.
All right. Let's get out of there. All right, there we have it, guys. There's the call. I appreciate you guys for watching it with me. If you guys enjoyed the stream, make sure you guys subscribe, drop a like. It would really help out. Enjoy your holidays if you're going to leave. I'm going to give a breakdown of what I see here. Well, I kind of wrote down some notes I got from the call, some key things. So obviously we see the stock right now. It's at $11.33. It has dropped following the earnings call, but the market reaction stands deep in a sharp contrast to the underlying fundamentals that the company has delivered. In many ways, the sell-off reflects short-term expectations. So we saw trader sentiment, we saw profit taking, and people that aren't taking into account the company's trajectory. When examining this closely, though, the results reveal that this company is not only scaling aggressively, but doing so with a lot of discipline and efficiency, which is something that many mining companies have had issues with over the last couple years, and these are becoming more pronounced each quarter. This earnings report was not about a negative surprise. It was about a company that is quietly consolidating, and it's becoming it's a leader inside this industry, while the stock price is temporarily mispriced on the progress. So at the center of the quarter is their clean transition from builder to operator is one of the main things I want to point out is this revenue climbed to just under $200 million. Quarterly revenues 198 million. This is absolutely massive, and I think it is one of the most meaningful signals that is inside the company's profitability. As they posted more than $250 million in net income, the company also reported the adjusted EBITDA, which was very strong this quarter, and it's showcasing how powerful the business becomes when fixed infrastructure is paired with growing hash rate. So as these infrastructures continue to get in place and they continue to become fundamentally sound inside the company, I think that this company stock will continue to evolve and increase as we've seen the reversal from last year. Operational execution remained one of the strongest aspects of the quarter. CleanSpark reached roughly 50 exahash of developed hash rate in June, putting it in the upper tier of global miners. And this expansion is backed by more than 1 gigawatt of contracted power, which is an achievement that cannot be overstated. In today's mining environment, where access to stable and affordable energy increases determines winners and losers. I mean, energy is one of the biggest problems. Every company that has been doing energy this year has done well. One of the main stocks I've bought this year is EOSE, and they've been absolutely on a tear, and it's up 142% this year, and it's probably more from when I bought it, but that's besides the point. The companies holds a long-term advantage though with this stability they have, and their power commitments ensure they can continue growing even as smaller or less efficient competitors face rising costs or supply constraints, which means that a company like this will be able to just buy out these companies and continue to grow at a higher level than any of the other ones because of these margins and this treasury we have, which is another key strategy I think for the company. This Bitcoin holdings of $1 billion with holdings at this large, this offers them dual exposure. There's operational earnings from mining and asset appreciation through long-term Bitcoin accumulation. So this gives the company operational optionality during both bull and bear cycles. So this has emphasized it does not. They said on the call that they do not plan to dilute and avoid dilution while scaling. So this is one of the main things that is also very bullish because most companies in this sector have relied on diluting their shareholders, whereas this company is constantly putting the shareholders first, and they have a lot of disciplined capital allocation, which has made them in a strong position here. So despite the progress, the stock's immediate reaction to earnings highlights the gap between the long-term fundamentals and the short-term sentiment. So Bitcoin miners often trade with volatility, and the earnings windows are moments where when expectations and the positioning combine with kind of the macro uncertainty and the but for me, as I'm looking at this earnings report, the underlying story remains very intact. CleanSpark is outperforming in a post-halving environment where many miners have faced a lot of compressed margins. So their efficient fleet, strong geographic positioning, and low production costs allow them to generate solid returns even as network difficulty rises. So their balance sheet is one of the main things that also I was looking at it before the call, but it really reinforces their strength, and it's what the main thing I like to focus with companies is the balance sheet. That is one of the most important things, and obviously we see the cash on hand is very modest for a company this size, but Bitcoin but inside of this, the company's asset base is still substantial, and the combination of high efficiency mining infrastructure and a rapidly appreciating Bitcoin treasury provides a lot of resilience for this company in the future. And they carry less than $1 billion in liabilities, which is somewhere on here, right here, less than a billion in half a billion in total liabilities. So against more than 3 billion in total assets. So their operating metrics continue to improve each quarter. They're looking like a better company every quarter, and this is something I like to see. So in total, I think that the earnings call confirmed that ClearSparks is one of the most strategically positioned miners in the entire industry. The temporary drop in the stock price does not reflect any type of deteriorating fundamentals. Instead, I think it just reflects a market that often misinterprets long-term investments and treasury gains through a short-term lens. So CleanSpark continues to build, and it continues to mine efficiently, I think this stock can continue to grow in the future. And as it continues to strengthen its balance sheet, as I was showing you guys here, the balance sheet is very fortified. And as it continues to do this and Bitcoin moves to be more expansive into 2026, this scale and efficiency is what will allow them to outperform the broader mining space in general. And that is kind of where my thoughts lay on the company. I'm not too worried about the stock price right now. We've seen a lot of stocks where they dip after the earnings call, and then tomorrow morning they rip up and at open, or they dip and then rip, or they dip, rip, dip, rip. So I'm not worried about stock price. If you're investing for long term or even trading, I mean, this is not a bad entry. Obviously, not financial advice. That is just my personal opinion, and that none of my opinions are any fact or anything. But if you guys have any questions or comments, I'd love to see them in the chat. I'm looking at the chat right now. I'll stay here for a couple more minutes. If not, I'm gonna head off here in a couple seconds to go eat dinner. But I hope you guys enjoyed the call. If you guys did, make sure you guys drop a like, subscribe. I appreciate you guys all for coming out. Um, yeah, it was a good call though in general. And I hope you guys enjoy your holidays. If you guys celebrate the Thanksgiving, if not, I mean, you get the day off from the market, so that's always nice. You don't have to stress about it for a day. That's always something relaxing. But if that's it, I'll give it one more second here, a couple more seconds, just to see if any questions come in. If not, then I'll just head out here. And yeah, that's pretty much it. I think I gave all my thoughts here on the earnings report. And if I missed anything, make sure you guys drop a comment. And I might do a video on this in the future as well, because I think it's a very interesting stock, and it's really just starting to expand, and it's finally at a position where I think it is a good buy. And that is why I started my position today, right after the earnings dropped at like 1170. Obviously, I'm gonna scale into it, but yeah, that's kind of where I'm standing at here with this everything I've seen today. Happy Thanksgiving. Thank you, Eric, my friend. Erickson, I appreciate you for hanging out and appreciate you for watching the call with me, my friend. Happy Thanksgiving to you and your family. Um, yeah, I think I pretty much went over everything. What time is it? 5:52. I live on the East Coast, so it's 5:52. Usually my mom makes dinner by 6, so I'm going to have to get off here any second. But I appreciate you guys, as I was saying. Have a blessed. This will probably be the last stream I do this week, but have a blessed Thanksgiving. Um, Take care of yourself. Be good. Be kind. And I don't see any questions coming in, so I'm probably gonna head off here. But yeah, that's pretty much all I have to say. Nothing too crazy. Nothing too crazy. All right, guys. Peace out. Take care. If you guys want, I'll upload this as a video if you guys want to rewatch or anything, see what I was